In terms of this year in 2024, it's been a pretty positive market. The S&P 500 is up to 25%, and the Dow Jones is about 16% now after this week's rally. It's incredible how the market responded to a Trump victory. I think things were priced in already. If you look at the fourth quarter in presidential election years, this is where you've seen 3 down quarters, right? The stock market crash of the 30s, the internet tech bubble in 2000, and then the global financial crisis in 2008. Otherwise, you've seen pretty positive fourth quarters in presidential elections year. So this is, to me, also pretty telling that the stock market doesn't matter who's in office or if there's a presidential election, it typically does well in the fourth quarter overall. So when you look at the drawdowns for S&P 500 versus Dow Jones, the Dow Jones has held up much better. So it does protect your downside, and I think this is very important, even as we, even through COVID as well. If you're looking at 100% in the STI, the Singapore, you would look at the growth of 10,000 over 20 years. This shows you that just by adding in the Dow Jones, you can add a little more, 1, diversification, but 2, boost your returns.
US stocks have performed very well, particularly over the last 10 years. And as a result of that, whether you look at the Dow or the S&P 500, they're all trading above their long-term PE ratios, the long-term average PE ratios. Why have US stocks performed so strongly, particularly in the last 10 years?
One of the reasons why I think US markets continue to be strong, and especially relative to a lot of other developed markets, is that it's now in a space where household as well as corporate balance sheets are just extremely strong. The average household sort of net worth is 800% of the individual's annual disposable income. Companies are extremely cash rich, partially due to the many years of quantitative easing and low interest rate environment in the past 10 years. Many investors also probably have a good amount of individual stocks like Microsoft, Amazon in your portfolio. You might not want to be overexposed to those stocks. So looking at the Dow Jones as an addition to whatever exposure you already have may potentially be a good idea.
I want to highlight those US companies, whether in the S&P 500 or Dow, they are not purely US companies. Roughly 70% of their revenue comes from US, but the rest 30 are coming from the rest of the world. If you look at S&P 500 Global BMI Index, the global equity, over 60% are actually US equities. So not the retail investor, but as a pension fund or as an institutional fund, when you think about the asset allocation, you cannot ignore this 60%. It's a very important, significant portion of their global equity investment opportunity set. So yes, the economy has been doing well, but then the capital, where does the global money going?
Sorry, so if I can just interrupt you also on that point, just to give you a sense. So since Donald Trump won the elections and Trump won the elections, we saw a staggering $22 billion flow into US equity ETFs, and this broke all kinds of records. The last time something like this happened in a single day was after the elections, the last elections when Joe Biden became president. And that was $4 billion. This time around it was 22. So it's a very large amount flowing into US equities ETFs, which again shows the confidence in the market.
If you take any economics and implications of those economics out of the election results, 2 of the biggest impacts on us and for these markets is obviously corporate tax, but the other thing is on the tariffs. Now, during the Trump 1.0 administration, tariffs, they became sort of specific and gesture-like to China. But it's not just about China in Trump 2.0. They're talking about other countries that have large trade surpluses on the back of their exports to the US. India's mentioned in there, Vietnam's mentioned in there, South Korea's mentioned in there. And during the last 4 years, those trade surpluses that these Asian countries have to the US have also got a lot stronger. And now when you look at expectations for where rates are going, if you look at June next year, your expectations for how low we go have actually been reduced by about 75 basis points. So we are looking at slightly higher interest rates than we thought. That also supports the US dollar, and it's going to make our life in Southeast Asia a little bit tougher, which I just want to end on, because the US, and I think either administrations would have gone this way, so that marketplace for international capital, whether it's portfolio inflows or FDI, is going to become a lot more competitive, albeit still in the same structural sectors that we're working in. So like I said, big seismic changes. We have to wait and see week on week how these things roll out. I think investors have to be a little bit more homework, a little bit more selective when it comes to mining out stocks, because there's not one shoe size that fits all when it comes to the sectors now. And now when you throw all the geopolitical lenses in there, that's going to make it even more diverse.
In this sort of environment, I don't predict the market, but that I would say it may be probably hard to see the US equity market have as high return as this year. Dividend yield, S&P 500 is about 1.4%, and Dow is slightly higher, given the characteristics that we mentioned, is about 1.7%. But then if you think about long term, it's also having that right mixture of the dividend and capital growth. If you compare the total return of the past 20 years with STI and S&P 500 or Dow, your total return, including dividend, will not be very, very different, because the dividend yield of 1.7% 20 years ago would be much higher portion now because of the capital growth that it has given, right? So you always have to think about these two perspectives, capital growth and dividend income. Dividend income, you get it today, but then the capital growth will give you more potential for future dividends. So having this right balance is important.
So if you buy anything that is listed in the US, be it an ETF or a stock, whenever it pays dividends, an investor in Singapore would get hit by 30% withholding tax. Let's talk about the Dow Jones ETF. It's listed in the US, right, on the New York Stock Exchange, and that's the primary listing. What a lot of people do not know is that the Dow Jones ETF is also listed on SGX. It's not a different fund, it's the same fund, right? It's the same ETF, it's a cross-listing. So what's the benefit between trading in the US versus trading in Singapore? One, of course, time zone, right? You obviously can trade during SGX opening hours versus having to stay up at night to trade in the US. But what I think is perhaps the biggest benefit for investing in a locally listing versus the US listing is the ability to be able to invest using non-cash avenues such as SRS, for example. We're coming to the end of the year. I've always been a big advocate of contributions to SRS, so if you have not, please be reminded to do so before the 31st of December if you want to save some tax for your tax returns next year. But yes, so the Dow Jones listed in Singapore is one avenue for you to be able to deploy your SRS money as compared to the US listing, because you buy anything in the US, you cannot use SRS money.